The statement of cash flows, or a cash flow statement, is the last financial statement we'll study in this series of videos. Cash flows is referring to cash that either comes into the company, so that is a cash inflow, or cash that leaves the company or is being dispersed, a cash outflow. This video is meant to serve as an introduction to the concept, theory, and the form of a cash flow statement, and in a later video, we'll focus on a numerical example. Let's get started. The purpose of a cash flow statement is to summarize an entity's cash receipts or inflows and payments which are outflows for a given period. And this can be used to determine an entity's ability to pay dividends and pay back debt, to predict future cash flows, or to evaluate the ability of an entity to adapt to the changing circumstances and opportunities that are presented in the market. The cash flow statement relates to the other financial statements in a few ways. Firstly, the cash flow statement is prepared at the end of an accounting period, right along with the other financial statements. As a quick review, consider a balance sheet that we know is prepared at a specific point in time, such as the end of December 31st for a given year. I've used 20x1. We know that even a year later, when another balance sheet is prepared, it will still be for a specific point in time. The remaining statements, including a cash flow statement, are prepared for a period of time. This includes the income statement, the statement of retained earnings, and the cash flow statement. In a way, we can think of these statements that are prepared for a period of time, a beginning date to a specific ending date, as connecting the two balance sheets that are prepared for points of time. So let's zoom in on the balance sheet. A balance sheet prepared in good form would begin with the legal name of the business, the name of the statement, and the specific date. We know that under assets, we have current assets and then we have cash. And a cash flow statement attempts to summarize the cash transactions that result from us going from, in this example, 200,000 in 20x1 to 285,000 in 20x2. Let's move on to a different way of viewing this. If we were to look at a T account, on the left-hand side we would have debits, and those would represent cash inflows, things like collections from customers or the receipt of dividends. On the right-hand side, we would have payments or disbursements for any number of different reasons. We know what these transactions are, debits to cash and credits to cash, cash in and cash out. But what does an actual cash flow statement look like? Let's take a look at an example. There's a lot to take in on this screen. You may wish to pause the video for a moment. I'll ask you to focus your attention at the very top. Like any other financial statement, this statement is prepared in good form. It begins with the legal name of the entity, ABCD Limited, at the top. Then the statement is named, Cash Flow Statement. Then indicated is the period of time for the year ended December 31st, 20x2, which would mean that the beginning of the period is January 1st, 20x2. Note that the direct method of preparing a cash flow statement is used in this example, but we will typically use the indirect method in our course together. I use the direct method to show it for the first time because I think it's a bit simpler to understand. Now I'd like us to turn our attention to the very bottom. And the very final line says cash and cash equivalents at the end of 20x2 is 285,000. Next from the bottom, it says cash and cash equivalents at the beginning of 20x2 is 200,000. And then just above that, it says the net increase or decrease in cash and cash equivalents is 85,000. What we see here are the ending balances from balance sheets that are a year apart, 285,000 in cash at the end of the current year and 200,000 at the end of the prior year. The difference between the two is 85,000. Now, how did that difference of 85,000, in this case an increase, come to be? Well, that is what is explained by the rest of the cash flow statement. We can see that the cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. And each of those activities either generate or use up cash. All transactions need to be classified into one of those three if it's a cash transaction. The direct method is a little easier to read when we look at the operating activities section. For example, how much cash was received from customers? Well, it says right there, 650,000. It's a lot easier to read, but many companies find this harder to prepare, and some companies would say it provides a little too much information to the public and, along with the public, their competitors. So most corporations will use the indirect method, which we'll get to in a minute. But first, I'd like to focus on these three sections of the cash flow statement. So as stated before, the cash flow statements classify transactions affecting cash into one of these three sections: operating activities. And that's when the principal revenue producing activities of the enterprise and all other activities that are not investing or financing activities will be classified into. Then we have investing activities. And these are the acquisition and disposal of long-term assets and other investments not included in cash and cash equivalents. Finally, we have financing activities. And these are the activities that result in changes in the size and composition of the equity and capital and borrowings of the enterprise. You could commit these to memory. Personally, I always like to think of it a bit more visually. So classifying cash flows. I used to think of it as any cash flows that affect the computation of profit and loss are classified as operating. So here we have revenues subtract expenses equals net income. And any cash flows that impact that computation can be classified as an operating cash flow. We can also turn our attention to the balance sheet. If you can think of a balance sheet that's prepared in left-right or accounting equation format, we have assets on the left, liabilities and equity on the right. Operating cash flows would be any cash flow transaction that impacts current assets or current liabilities. Investing cash flows are a result of cash transactions that impact long-term assets, so the acquisition or sale of a long-term asset. And then liabilities and equity would be financing cash flows. And hopefully that stands to reason. We finance our activities, our operations, by either using equity or by borrowing. Let's take a moment to do some practice where we can classify the transaction. Take a look at the different transactions on the left, numbered 1 through 5. Pause the video and try to classify each of those transactions into a section of the cash flow statement as either operating, investing, or financing. Go ahead, take a second to do that. If you're back, let's take a look at item 1. The collection of receivables is an operating cash flow that impacts current assets. Interest received can be classified as an operating cash flow because this impacts the computation of net income. Credit sales is actually a trick. It's not a cash transaction at all and wouldn't show up directly on a cash flow statement. The purchase of land is an investing activity, and the payment of dividends can be considered a financing activity. Let's focus on the operating activity section of the statement. As I mentioned earlier, there are two ways to format this section. We could use something called the direct method, which reports all cash receipts and cash payments from operating activities. It's pretty easy to understand, harder to do, and honestly, I've never seen it done in industry before. What I've seen that is much more common is something called the indirect method, and this reconciles net income to net cash provided by operating activities. We're going to look at a new example on the next slide. Now again, this example, even though it's a new set of numbers, it is still the direct method. You can see that we have cash flows from operating activities, and this is broken down into cash receipts or cash inflows and cash payments or cash outflows. And it's pretty easy to read. Collection from customers is $650,000. The interest received on notes receivable is $24,000. The dividends received on investment in shares is $22,000, and on and on. I'd like you to focus on the very last number. Net cash inflow from operating activities is $168,000. The next slide is going to look very different. This is the indirect method. You can see at the top where it says cash flows from operating activities, and it begins with net income. To net income, we add or subtract items that impact net income and cash flow differently. And there are some things being added and some things being subtracted. All I really want you to get from this is at the very end, it says $168,000. The two methods are different, but they result in the same amount. So in summary, the cash flow statement is used to summarize the inflows and outflows of cash for a period of time. Transactions are classified into one of three sections: operating, investing, and financing. The direct method lists cash receipts and payments. The indirect method reconciles net income to cash. The indirect method is what you will probably see throughout your career. In the next video, we're going to focus on making an indirect cash flow statement. So until then, thanks for watching, and I'll see you next time.